So what on earth does a central bank do when the economy is sending two completely different signals at the exact same time? It's like the engine is sputtering, but the inflation alarm is still blaring. Today, we're going to break down a razor-thin decision that had policymakers absolutely deadlocked.
Okay, so picture this. The economy is clearly slowing down. The textbook answer is pretty simple, right? You cut interest rates, make it cheaper to borrow money, and you get things moving again. But what if that simple fix could actually make a much bigger problem even worse?
And look, this wasn't just some academic debate. For the UK's Monetary Policy Committee, the decision they faced on November 6th was so tough, the room full of experts was split right down the middle. The final vote, get this, a perfect 4-4 split, a complete stalemate. The entire decision, which was going to affect millions of people, came down to just one person, the committee chair, who had to be the tiebreaker.
So how in the world did they end up in a deadlock like that? Well, let's start with the case for a rate cut, the evidence pointing to an economy that was really in need of some help. First up, you had the unemployment rate, which had crept up to 4.7%. Now, when more people are looking for work, it's a classic sign that businesses are tightening their belts and people have less money to spend. The economy is losing steam. But it wasn't just about unemployment. No, the number of actual job openings, job vacancies, told an even more dramatic story about just how much the economy was cooling off.
For 39 straight quarters, that's nearly a decade, the number of available jobs had been falling. This wasn't some temporary blip. It was a long, sustained signal that companies were hiring less, probably bracing for a downturn.
So for 4 members of that committee, the writing was on the wall. All of these data points were screaming one thing: cut interest rates, and do it now to get ahead of the problem and avoid a really unnecessary slowdown. Okay, but what about the other 4 members? They weren't ignoring the slowdown. No, instead they were laser-focused on a different, and let me tell you, a very stubborn number.
And this is where the story gets really complicated. Because even as the job market was cooling, wages were still growing at a scorching 4.7%. That's way, way above the level you need to keep inflation down at its 2% target. And why is that a problem? Well, because when wages go up that fast, businesses often just pass those costs right on to us, the consumers, through higher prices.
You know, economists have a word for this. They call it persistence. It's the fear that everyone just gets used to high inflation and bigger pay raises. And once that mindset sets in, it creates this vicious cycle that's incredibly difficult to break. For half the committee, cutting rates right now would be like throwing gasoline on that fire.
So you've got this 4-4 deadlock. You've got powerful arguments on both sides. What finally breaks the tie? It all came down to a single, external factor, a huge risk that was looming just on the horizon. And here was their massive strategic dilemma. They had to vote on November 6th, but they knew that just 20 days later, the government was set to announce its new budget, an announcement that could completely rewrite the economic playbook. The big, known unknown, the thing everyone was whispering about, was a potential tax hike, specifically an increase in the value-added tax, or VAT. A VAT hike would mean the price of almost everything you buy goes up literally overnight, just pouring fuel on that inflation fire they were trying so hard to put out.
This created what you could only call a potential nightmare scenario for the central bank. Just imagine it. They cut rates, signaling to everyone that they think inflation is under control. Then, just a few weeks later, boom, the government hikes taxes, sending inflation soaring again. The bank would be forced into this humiliating U-turn, having to raise rates right after they'd just cut them. That kind of move would absolutely shatter their credibility.
So you've got a slowing economy on one side and this massive risk to your credibility on the other. The chair had to make the final call.
And when they weighed all the risks, the choice became a lot clearer. The potential damage from a government tax hike combined with that wage growth that just wouldn't quit, well, that was a much bigger, much more immediate threat than the risk of a slowdown. The upside risks to inflation were just too high.
And so they held the rate at 4%. Now, this wasn't a vote of confidence in the economy, not at all. It was a strategic choice to just wait and see, choosing stability over what could have been a preemptive gamble.
But this doesn't mean a rate cut is off the table for good. Oh no. The committee laid out 2 very specific conditions that need to be met. First, that upcoming government budget can't contain any big inflationary surprises. And second, new data has to show that sticky wage growth is finally cooling off faster than they expect.
Which of course leaves us with the critical question. By choosing stability today, did the bank just guarantee more economic pain tomorrow? They dodged a credibility crisis for sure, but in doing so, they might have just ensured that the very slowdown they feared becomes a reality. It's a high-stakes gamble, and there's just no easy answer.